This is the special board meeting. Today's date is Wednesday, June 12th. Time is 8:15 a.m. And it's a special meeting in regards to our audit and some other unfinished business. And I'd like to call that meeting to order. Opening session, we have Mr. David Spera, who's a Petoskey company, who is going to present the audit, and I'll also present it to you, Wade, where you want to take it from here.
Thank you. At this point, it's appropriate. We'll turn it over to Mr. David Sparrow from Petoskey. David.
Thank you very much. Since I've already been named twice, I don't have to introduce myself, I guess. But what I will do is I'll take this opportunity to hand out some business cards. The reason being is that if anybody has any questions that come up after this meeting is concluded, all my contact information is on here. Please feel free to utilize it. And that includes not only the board members, but also the staff. And I gotta make sure I get one to get here to Fred, because I cannot run out before I get there. And regrettably, I'm gonna come up a card short.
No.
I'm not? Perfect, I have the exact number of cards that I need then, and we're all set.
Thank you.
What you have before you are 5 separate reports. There are 2 reports to the board. The reason there are 2 is because one is for the border station and one is for the Bridge and the Port Authority. You have one management letter, and we issued a single one because the process and procedures that are in place are really the same for both organizations, so issuing a separate management letter on the border station and the Port Authority would be redundant. And you also have 2 financial statements, one on the bridge and the port and the other on the border station. And
Excuse me, let me interrupt so that, people can preface, whatever was happened in this process. We met last evening for about 2.5 hours, and that was an informal session, or actually formal, whatever you want to say it, with the finance committee, Mr. Barlow, Mr. Hooper, myself. So this is, the discussion that we have is also precluded with 2.5 hours of review and questions and comments, whatever. So the formal part, whatever, it's a lot of other questions been answered that probably won't be covered in this meeting, but I think, Dave, I think we ought to at least let the public know that's exactly what our process was and what happened. So sorry about that interruption. I should have said that first, but go ahead, I'm sorry.
you're fine. What I'm gonna do is I'm gonna address the reports in essentially the same fashion I did last evening, and I'm gonna direct your attention to the first report, which is the single-page report. There's a management letter, and there is a single management letter comment. This comment relates to an internal control finding that we had with regard to the timeliness of the preparation of bank reconciliations. We discussed this a little bit last evening, and there were some staffing issues that occurred, and because of the lack of personnel and manpower, or womanpower as the case may be, these were uncompleted for a period of time, and they were caught up in a block near the end of the year. The issue is not so much that they weren't done at all, as much as the timeliness with regard to that. That is the extent of that, and I assume that now that there are sufficient personnel on board to handle the administrative tasks, that won't be a repeat finding for next year. Next thing I'm going to direct your attention to are the 2 small reports. They are both labeled report to the board, and I'm going to address them together because, again, a lot of the similar topics are covered under both of these reports. Our profession has determined that it's critical that we convey to boards of directors and boards of governance and people who are not the operating management of an organization, that we convey to them certain information. And this document is the formal presentation of that information. And it typically contains anywhere from 9 to 11 points of information that the profession feels that we need to be sure that you understand, and that we need to make sure that we have conveyed to you. And I'm going to do them both together because the issues that they address are similar. The issues that is related to 2 entities are very, 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 very close. And what it comes down to is were there any significant audit findings and the qualitative aspects of the accounting issues with regard to the organization. What this really talks about is how do you keep your records and the accounting policies and procedures that you have in place. you are a public authority and a not-for-profit that, because of the component unit nature of the border station, also is now following governmental accounting standards. Without getting into how those standards are set and whatnot, the purpose of this particular paragraph is to just state that those are the standards that you're following and identify any changes that took place. There were some significant changes that did occur in the government accounting standards setting body this past year, and they're enumerated here. They issued statements 62, 65, 63, and several others that are not pertinent to you, but those three certainly did have an impact on you. Particularly 63 and 65, which changed not only the format of the presentation of your financial statements by removing the terminology of net assets, but it also changed some of the content of them, because the bond issuance costs that were heretofore reported as an asset of the border station and being amortized over the period of the redemption of that bond issue. The GASB has determined that those are really period expenses and should not be capitalized and amortized. So there was a write-off and a prior period adjustment as a result of that particular financial statement. And you'll see that in the financials when we get to that point. Second item here is difficulties that were encountered, and quite frankly, there were none. And I have to digress just up to the paragraph immediately above that. It talks about certain sensitive disclosures. There are several. One is estimates, depreciations, and estimate. We spent a great deal of time last evening discussing the value of the capital assets that the authority and the station manage, and what the fact that book value does not necessarily represent economic value, and the fact that your financial statements are governed by the reporting guidelines, which say historical cost, and you depreciate them. Those are the ground rules by which we must play, and that's how your financial statements are prepared. There's a disclosure with regard to your pension and your post-employment benefits, which can be more significant and less significant in other entities based on the number of employees that they happen to have. The authority does not have huge obligations in that capacity because you manage capital assets with a very small cadre of workforce. Okay, so your pension obligation, while it's still $250,000, it's a far cry from the tens of millions that I see in a lot of other public entities. You do have a little bit of litigation floating around, and that is predominantly all contained within the court and the bridge, and that is disclosed in the notes. And because it's litigation, it is a sensitive area, and it's just brought to your attention that area there. Page 2 of these documents looks very similar also. Talks about corrected and uncorrected misstatements. There were some journal entries that were disclosed during the course of the audit, some that we came up with, some that Fred and his staff came up with, and collectively they have all been made. So the financial statements as you see them right now are fully adjusted. There's nothing floating around. There's nothing that has not been booked of which we are aware, of which they have told us that they're aware. We're happy to report that there were no disagreements with management. There were no, gee, we don't want to implement the standard, we don't agree with this journal entry. There was none of that. Everything was very, I don't want to say cordial, but it was very appropriate. Management representations, there is always issued in connection with any audit engagement of what's referred to as a management representation letter. That is going to be provided to Fred, and he and the executive officer will go ahead and sign that document and return it to us. It's basically, and I've seen them as long as 8 to 10 pages and as short as 2. So depending upon the entity, it's like an accordion. But it contains a series of representations that that management that support the representations that management has made to us. So that when we asked Fred for his general ledger, he gave us the real general ledger and not one that he kind of sort of keeps on the side. And the fact that we were provided the real board minutes, and that the financial statements, there is no fraud of which management is aware, and there's a whole laundry list of representations that conveys so that we can come in on a very short window into an organization, be given the information that we need to do our job, and rely upon that information so that we don't have to spend the whole year out here, which makes it a very cost prohibitive kind of an activity. Management's consultations with other independent accountants, we weren't aware of any with regard to any of the organizations, and if we were, this would be the place where it would be disclosed. So if you were to say, want to have a second opinion as to, gee, we don't think this is an appropriate standard to implement, we think that have somebody come in and evaluate the collectability of the receivables or something like that, this is where that would be discussed. And any other audit findings and issues, and the answer is really no. There were none that occurred. And that really covers both of these reports. How are we doing so far?
Excellent.
Very good.
What you're left with now are the two FAT reports, unfortunately. And I'm going to address the border station first, because there are a couple of things that occurred here that are unique this year, and I'm going to kind of move through them a little quickly. The very first thing you'll notice is that on the cover it says the border station is a component unit of the Ogdensburg Bridge and Port Authority. It's disclosed that way over in the bridge and the port. It was not disclosed that way over here. This is something that's typically a government accounting standard issue where you disclose that. And it is disclosed right in front of the financial statement. I'm going to direct your attention real quickly to the table of contents. This is where the changes that are impacting your financial statement start to occur as a result of the government standards. And what you have here is, the first thing you see is it says statement of net position. And quite frankly, in the profession, we would catch that. I'm sure that most everybody at this table probably read right over that. But net position is the new buzzword. It replaces net assets, which heretofore is what you reported on your balance sheet. And now it's referred, or your statement of financial net position, now it's referred to as statement of net position instead of net assets. The following two pages, and I've kind of gotten myself out of sequence here, and I'll say this with regard to this document, and this also applies to the other one. This financial statement, cover to cover, this is the representations of management. That's all you have to get, that management representation letter. There are only a couple pages inside this document that are not management's, and that's pages 1, 2, and 3, which happens to have our stationery on it and our letterhead, and that is our opinion. While the financial statements are the representations of management, the opinion on those financial statements is ours. It's essentially, at the end of the day, the only thing that you pay us for, and the only thing that we really provide. That's what gives you the independent look at your financials and say, yep, we rely upon Fred and staff to produce these documents, and we had somebody else come in and take a look at them and give them the sniff test. And in fact, they present fairly the financial position and results of operation. And at the end of the day, that's what you want to hear. And this new format is referred to as the clarity standards. And at the very top of page 2, actually it's the first heading on page 2, you'll see the word opinion underlined. And that is now what's referred to as an unmodified opinion. It used to be a clean opinion or an unqualified opinion. The new terminology is it is now unmodified. And it is the same opinion in both the bridge and the port as it is here in the border station. And it is an unmodified opinion. These financial statements do present fairly, without qualifications, the position and results of operation for the years ended 2013 and 2012 for both organizations. They are presented in conformance with generally accepted accounting principles for governments. And there's some discussion of the paragraph that immediately below that, which talks about the standards that have changed with regard to those principles between last year and this year. Why? Accountants live and die by consistency. We like to go ahead and have our financial statements be able to be the same this year as they were last year, and it would be really great if the numbers didn't change, but they really do every single year. But the principles by which we assemble them are things that we don't like to change. So when we do change them, and we only change them because we're told to change them, we always make sure that that's disclosed, and that's the purpose of this particular paragraph. There are some other paragraphs in here that talk about some supplementary information, and again, it's the same between both entities. There's some supplementary information included in both of them, and each has a report that's identified as this in accordance with government auditing standards. It's a report on internal control over financial reporting and compliance. It's the very back of both reports. It is a clean report also. It says that there were no major issues, there were some journal entries. One thing that you'll notice is this report does look a little bit different than it has in the past because it does have these headings. This is the impact of the clarity standards. For whatever reason, the profession determined that there was some confusion with regard to everybody's roles, and they thought that cleaning up this presentation would facilitate that level of communication. So this now clearly identifies what management's responsibility is, which is you are responsible for the financial statements. That is the second paragraph in this report. And then it identifies in the big paragraph at the bottom of page 1 what we're responsible for. And that is the application of generally accepted auditing standards and the expression of an opinion. A change in the border station report from last year to this year is the presentation of what's referred to as management discussion and analysis. MD&A is referred to the profession, is a required component of any government financial statement. It is not a requirement of a statement prepared in conformance with financial accounting standards that are not applicable to governments. This basically is a comparative analysis of this year's operations and last year's, and includes a little bit of narrative. Because this is a conversion year, the one for the border station is a little bit on the more primitive side. It was not expanded greatly. This is an item that, again, the first word here is management's. This is the place where you can expound on the economic events that have occurred, where the organization is going, what occurred during the course of the year that made your results different from the previous year. So if things were good, you can talk about it here. If things were bad, you can talk about that here too. Once you're off of this MD&A pages, you are basically locked into the boilerplate presentation that GASB dictates of how your financial statement numbers are presented and what the contents of the notes are, which has got to be, they have to be unambiguous and basically pretty bland and straightforward. And it almost reads like boilerplate. So MD&A is the place where you can expand on your operation a little bit. I'm going to go ahead and kind of skip through it, even though it really highlights the rest of the report, and get to page 6, which is the statement of net position between the 2 years. And what you'll see here is that the predominant asset that the border station controls, which is similar to what the bridge and the port have, it happens to be the capital assets, which is the buildings and improvements. And right there where it says net property and equipment, $5.9 million of your total $6.2 million of fixed of assets are assets that you can only go ahead and manage. You can't buy groceries with them, you can't pay your bills with them. It's the facility with which you are charged with controlling, and the facility which in this instance you rent and therefore generate your operating income from. You have a modest amount of cash, about $350,000, and beyond that, it's a little bit of cash and a lot of buildings. The border station also has a bond issue, which is about $3.4 million, and you got $605,000 of which is currently due and will be paid sometime during the course of the 2013-14 fiscal year. 2.7 is long term. If you flip to page 7, what you'll see is this is the operating statement. It has a longer name. I'm just going to leave it at the operating statement. This is what really occurred during these 2 fiscal years. And you can see that your rental income is relatively consistent. It's up $90,000 on a $1.1 million base. Your operating expenses are essentially the same number, within a few $1,000s of each other. There was some discussion last evening as to, gee, depreciation was the same number. And it will be until assets are either new assets are capitalized or old assets become fully depreciated. That third line up from the bottom says changes in accounting principle. That is the item that we discussed earlier. Those are the old bond issuance costs going away. That's that $173,000 that's over in the right-hand column. Those are being amortized over the life of that bond. They are now all fully written off because that's the way the government accounting standards wants them according to GASB 65. It's a one-time change. Since they're off the balance sheet, there's no future amortization associated with them. They've just been expensed. Your statement of cash flows is on page 8. It essentially shows you where the money came from and where the money went. Essentially, because of the nature of the operation, you operate in almost a near cash mode as it is. Receivables are not a really big component, payables are not a big component other than your bond issue. One thing that is interesting that this does disclose, however, is the redemption of the bond, and you can see that in 2013, there was $575,000 in the middle of the page there that was actually paid off in principal on the debt. The notes start on page 9 and run through, I believe, page 14, if memory serves me right, and they do, and it is, that's a good thing. These are significant pages because when you read a financial statement, it's prepared in accordance with GAAP. You need to go ahead and, I know what's behind some of the numbers. This tells you the principles by which they were assembled, the definitions behind what's contained within the different captions. And anytime you read a financial statement, it's always very helpful to read the notes. Should you have any questions, that would be the first place to go. It talks about your change in accounting principles. It talks about the composition of the assets. It talks about the fact that the border station, unlike the bridge and port, files in 990 because you are an Inc. and therefore have a tax reporting status. Page 12 discusses your cash with fiscal agent as a function of the bonded debt that you have. There is an obligation to maintain some money with M&T Bank as part of the covenants there. There's a disclosure relative to the composition of your fixed assets. And very importantly, on pages 13, quite honestly, is probably the most significant page of the notes. And that relates to what's going on with your bonded debt and what's the status of your lease agreement, which are the two biggest drivers of your cash flow. Where are you spending your money and where are you getting your money from? So page 13, quite frankly, is probably a very significant page in this document. Page 6 just discusses some of the related party transactions that occurred between the border station, the bridge, and the port. That's all required disclosure. And the very last two pages, 15 and 16, are the report for GAGAS. This discusses internal control over financial reporting, and it does not identify any significant deficiencies, which is a good thing. It talks about a little bit about compliance and other matters. So with regard to grant administration, compliance with laws, contracts, stuff of that nature. We are not expressing an opinion on that, but anything that we looked at did not disclose any violations with regard to that. The profession used to provide what was called negative assurance there. This is how we express that today. Everything we looked at was not in violation of those items. And then it talks about the purpose of this report. And that gets us to the end of the border station.
The question I have, and it's kind of like a whole picture of management fees, and how you show management fees in or how do you come up with a management fee for the airport versus here the border station, whatever. I mean, I don't know how that works. I mean, the percentages of what your time is, or maybe Fred or Wade could explain to me that part of it.
Are you asking about the wage allocation between?
Yes, yeah, I
between
mean,
assets?
our expenses and fees are things that we come up with. I mean, how do I know that
I
you
think
spent?
it's two different things, Sam.
Yeah, I know that.
There is, with the border station, there is a management fee that is a standard amount that it's the same all the time.
Right.
The other part of the question is, how do we allocate our costs? We make an estimate as to the amount of time that each of the management staff spends at each activity. So, maybe Wade is 5% airport, 20% port, 20% at the industrial park, and the rest at the bridge. So that's an estimate that's made, and then we allocate
Is that a constant thing, or
No,
particularly?
we look at it
say,
each
one
and every
the
year.
Airport's
It
taking more
changes
time,
year to
okay,
year.
so you're assessing that type of,
Mhm.
those numbers that way.
You
Right.
see the output of that process in the, it's in one of the budget schedules that we look at when we do the budget report.
Okay. Now, it brings me to the question, for Dave, you said, I mean, maybe I misunderstood this border station is now blended into our whole overall picture.
Correct.
So how does that work with the management, I know the management fees and how we categorize our expenses? How do we do that? Do we do that differently?
The border station itself, does have and that is disclosed on page 7. There is a $329,000 management fee expense here. That management fee expense that's reported here in the border station is really not so much a cost allocation model as much as it is a contractual obligation as a result of the borrowing and the lease agreement that the border station has with regard to the debt and the operating lease that it runs under. And the terms of that lease or the terms of those agreements dictate that whatever the you have rental income of $1.1 million, $1.2 million, and the vast majority that's associated with a specific lease, and the terms of the lease and the borrowing agreement are such that it states that the difference between that rental income from that lease and the cost of carrying the debt or servicing the debt, which is both principal and interest, is payable to the Bridge and Port Authority in the form of a management fee. And what that really is essentially saying is that the excess cash flow that the lease generates is pushed over into the Bridge and the Port to provide cash flow for the Bridge and Port Authority operations. And there is a schedule on page, the last note, under that related party transaction, under item number 6, where it actually discusses the computation of how that management fee is calculated. And it shows the annual lease payment and the annual bond payment, which is inclusive of both principal and interest. And that's how the management fee in the border station is calculated. And this fee expense over here is fee income over in the bridge.
Wow. Now, that being said, will we get this report next year in the same format? I mean, we'll get separate still, the border station will still have its own identity?
Correct.
Okay, but it still, is the auditing purposes, it's a blend of,
The border station is a separate legal entity that was
Right.
formed, and I can't remember the year off the top of my head, it's in the notes here, and it's really not that important for this question here, but
No.
it's a separate legal entity that was formed to handle a specific activity on behalf of the Bridge Authority. And as such, it services only the bridge. It is governed by this body here, and is managed by this administrative staff there. So it is what, it satisfies the criteria of what's defined in the government accounting standards to be a component unit. And when we take a look at the bridge financial statement here, the border station is, it's a blended component unit. It's pushed right into the numbers. It's transparent. It's part and parcel of this entity, but it is its own legal entity, so it has its own separate financial statement.
okay.
And a lot of that came because of the bonding.
Yes,
That's the issue with the bonding.
because it was a
Once them are
taxable bond.
satisfied, once that's all satisfied, eventually the border station will become part of the Bridge and Port Authority. It won't be a separate unit at that time.
Well, the entity itself would need to be, there was a separate corporation that was formed called the Ogdensburg Bridge Station, Inc. And even once that debt is paid off, that entity continues to exist unless by operation of law, in the formation agreements, it were to be dissolved. And then what would happen is, the assets would roll up into the bridge and the port.
Right.
But,
It will become a Bridge and Port Authority asset at that time. But that's down the road.
Yes, that's 2018 when the debt is
Yeah.
paid off
Yeah.
before that could possibly occur, so.
The one thing I wanted to bring up on what Sam is talking about and what you folks are talking about over there is your time and your charge. I thought you heard you say you do it on a yearly basis, but there has to be a monthly log on what it comes to at the end of the year, right?
We don't do it to the exact, it's not an exact science. If my time is 10% airport, it could be 8, it could be 12, it could be, we use 10, because it is an estimate.
It seems like the supporting evidence would be the reports that you give us each month anyway.
Sure.
Where Wade says I did this, and you say I did it, and John, and so forth. That's a supporting evidence for, and it wouldn't be exact, but it would be, give you
Yes.
some reason why you said 8 or 12 or whatever.
Right. Right. And then each month or each pay period, our time, our pay, is charged to a certain unit. So I don't know, and I can't remember, but John may be charged to the port. Wade may be charged to the bridge. And at the end, we true that up with those percentages at the end of the year. We don't do it every 2 weeks. We don't say, what was your percentage, and divide my wages 4 ways. We put all mine, I think, in the bridge, and maybe all of Steve's in the port, and then we true it up at the end of the year.
My question again was, you have supporting documents to that.
Yes, absolutely, we do. Yep.
I mean, you just don't come up with a number at the end
No,
of the year.
no,
Right.
no,
That's
we don't dream
all
it
I'm
up.
saying.
And plus, we look ahead too, like the year we had the bridge project, we knew that it would take more time to do the bridge project, so the percent allocation changed during that year.
And some of that was reimbursable.
Mm-hmm. Yes.
So, well, okay. Do you understand what I'm saying?
Yes, absolutely.
The only question I have regards to, border station, whatever, the assets or cash flow, whatever, in that account, can that be used anywhere else, or is that just totally just specifically to be used with the border station? I would say I got $500,000, I made $500,000, but I'm just using a fictitious number here. Can I use that cash anywhere else as a port authority? Or does it have to be just used for border station? I don't know if I'm answering the question correctly, but,
Yeah,
I
you
understand
understand, right?
I know what you're saying.
yeah.
The,
I mean, I need $500,000, and so I get this account over here, can I, I need some money for the airport, can I go into that fund?
the border station is kind of does not offer you the out, okay? And the reason I'm gonna say that is because the border station cash flow is essentially 100% locked up in, it gets its cash flow from the lease it has, and then by contract, what it does is it can only pay the debt, which takes about 75 cents on the dollar right now of what the total cash flow is that it generates. And then by contract, or by law, by the agreements, that residual cash flow is transferred over to the organization that operates it, which happens to be
The bridge.
the bridge, okay? What the bridge then does, now the bridge is the cash. Now the bridge has that cash, okay? How the bridge manages its cash is really the question that you're driving at. And as we talk about the bridge financial statements, what this is going to disclose is, under one of the notes, and I forget the note numbers near the end here, it talks about the fact that cumulative to date, there has been roughly $10 million in change of cash flow that the bridge has generated that has been pushed over and provided to the port for all of the port activities. And whether we call it the airport, or whether we call it the terminal, or whether we call it the industrial park, it's been pushed over into that pot and used by the port to meet its contractual obligations. As we discussed last evening, from an operational standpoint, There is cash flow, once you look at the net of the financial statement outcome, because of the significance of depreciation, the expense associated with this depreciation really kind of skews this, okay? Because you manage $100 million of capital assets in the bridge and the port, and your depreciation is a big number. The upside to that is the fact that you don't have to write a check for that. The only person that's really writing a check for that is essentially the border station, and there's some minor cash flow that comes out of the bridge and the port for servicing some New York State debt, but that's only a couple $100,000 compared to about $750,000 for the border station.
Thanks for that.
Which was an excellent segue, by the way, to the last document that we have to discuss here, which is the Bridge and the Port Authority. And I did this presentation in the sequence on purpose because this is kind of building, and a lot of what I discussed in the border station actually flows through, so I can kind of skip over some things now. Under the table of contents for the bridge and the port, what you're gonna see is there are some additional items here that are not pertinent to the border station. Those include the Schedules 1 and 2, which identify bridge and port activities, plus some required supplementary information for the other post-employment benefits. Since there's no employees in the border station, there's no ERS obligation, there's no post-employment benefit obligations. All your people cost is contained in the bridge and the port. The very last item on this table of contents also is pertinent only to the authority, and that is the independent accountant's report relative to compliance on the investment program. Why? Because you are a public authority and you're subject to the public authority laws. The Ogdensburg Bridge border station is not a public authority, so it's not pertinent to them. The opinion on the next page is same clarity standards apply. It has the same opinion. We did, however, change the name because the name is different here. Now we're talking about the Bridge and the Port Authority, but the opinion is the same. And it's still an unmodified opinion under the new clarity standards, and it does discuss the fact that this is in conformance with generally accepted accounting principles in the United States of America. There are IFRS out there now, which we aren't even gonna go there. The other disclosures are identical. We've got the disclosure with regard to the GASB, you've got the required supplementary information, the other reports that are applicable here. The very last paragraph here talks about, the top of page 3, addresses the fact that we issued that investment report. MD&A for the bridge and the port is contained on pages 4 to 11, or 4 to 10, I'm sorry. It's far more robust than the MD&A associated with the border station. That's because there's a lot more going on here in the bridge and the port than there is in the border station. You have about $75 million worth of assets that you're managing, and there's a little narrative in here which discusses each of the profit centers: the port, the railroad, the airport, the commerce park. Page 7 has the thing that I particularly care for, that I like to see in the MD&A, which is the outlook.
Can I interrupt you for just
Certainly.
a quick second? Based on the new treatment of the border station, should we also have a separate one in here regarding strictly the border station now? Would that be
Border station has been
conform-
historically rolled in here.
Okay. Or just leave it under the port?
You certainly could go ahead and stick it in here.
Okay.
And again, this is, one of the things that's nice about MD&A, or management discussion analysis, is that it is unaudited. You can essentially say whatever you'd like in here, and the only thing that we do with the MD&A is make sure that the numbers tie,
Okay.
and that there's nothing that's factually inaccurate, like the cost of living went down 45% last year. We would catch that. Okay. But we do check it for factual accuracy, but beyond that, you are basically entitled to wordsmith it to your heart's content. So if you'd like to talk about that, absolutely. What I like is and as I started to say, is on page 7, it talks about the outlook. This is where a board can put its best foot forward to say the good things that it is accomplishing. This is a great PR tool, and if you can go ahead and include something like that in your financial statements, this is the place to stick it in. And as I said last evening, this is management discussion and analysis. You people are way more familiar with your operation than your external auditors could ever possibly hope to be. So it's really best when management prepares this, because you know your operation so well, and where it is, where it's going, and how it got where it is. The rest of this is comparative financial information, and again, I'm gonna talk about it here only because this way I'm gonna skip some of the stuff when I get to the financial statements then. And I'm on page 8. It talks about your assets, and not surprisingly, as I said before, you have very limited current assets. Current assets are your cash and receivables. What you manage is a significant capital asset, and that's that $70 million capital asset, which is the bridge and the buildings and the port and everything else that you have over here in the airport. Your liabilities, again, are not significant. You have total $24 million, and $1.5 million is current. That $1.5 million is a little bit of debt to the state of New York, and this also because the border station is a component of this entity. The current portion of the border station debt is also reflected there. So all of that $600,000 worth of bond principal that's due with 2013-14 is included in that $1.5 million. Okay?
I think the question I asked last night was the asset value of the bridge and all those type of things, whatever, and it's like, where do you get that number? I mean, the replacement value, the value of it, economically for the area, type of things, whatever, that number is really probably, I guess the best way to put it, if we have to paint it for $66 million, what is the value of that bridge? How would you really come up with that calculated number that's what it's worth? And, maybe you could explain that a little different, how you came about, and it's,
I would explain that by directing your attention to page 9. Because page 9 states it very succinctly, and if you look right there in the middle of the page under capital assets, it says original cost. Cost is the basis under which assets are valued in financial statements prepared in accordance with governmental accounting standards. There are financial statements that can be prepared on other bases of accounting. If you were in a liquidation mode, and there are, as we discussed last evening, there are alternate mechanisms to value virtually any capital asset. You can take a look at its alternative uses, its best use, its discounted cash flows. There's a whole laundry list of mechanisms that you can use to value a fixed asset. And because of the variety of them and the need to be able to produce a financial statement for your entity and another entity and another entity and evaluate them on some sort of comparative basis, they said we need to come up with a single method for typical financial statements to present them, and that basis was cost. It is not necessarily any indication as to market value, nor does it represent itself to be representative of market value. It's merely, this is what you spent for it, and the use of estimates in preparing a financial statement is an integral part of it, and the fact that you buy an asset, whether it's a bridge or a car, that asset only has what's referred to as a useful life, and whether it's 50 or 100 years or 3 to 5 years, that's dependent upon the nature of the asset. And even at that, it's merely an estimate. You put a lot of miles on your car and you're gonna burn it up in 3 years. If you happen to leave it parked in your garage most days, it'll last you 10 to 15. But you're still gonna write it off over some ratable period, and it's probably gonna be 5. Okay? So it is cost. Page 9 talks about, and I'm gonna direct your attention to the top table on page 5, where we talk about your, the change in the net position of the entity for the year. And while the change for the year was $180,000, which is about the fourth or fifth number down under the 2013 column, I want to direct your attention again over to the 2012 column, about 2 lines down from there, where it said, discloses again that $173,000. As we talked about before, the bridges, the border station is rolled into these financial statements. That number is gonna look exactly like the number that's over in the border station, because it is the number from the border station. That entity is just rolled into these financial statements. And that was the only change that occurred, by the way. There was no bond issuance costs or debt issuance costs contained in the bridge to the port. It was only contained in the border station. You did take in $180,000, or realize $180,000 with the net profit, or change in that position to the positive last year. And that drove you up to about 49, just a little over 49, almost $49.5 million, just short of that. The long-term debt is disclosed at the bottom. I'm gonna skip over the capital assets because we did discuss those. And again, most of your debt is tied up with the advances to the state of New York. You have $3.3 million in bonds, is all the border station, and as we said, about $600,000 is due next year. That debt, by the way, runs out in 2018, as you'll see a little bit later. Page 10 is the page that Fred probably doesn't care for, because that means if anybody has any questions, they're just gonna go ahead and write him a letter and ask him, and he's gonna have to respond to that. Once we get past that, we're into what is the nuts and bolts of your financial statement, and that's pages 11 to 16. These are your statements of net position, your statement of changes in net position, and your statements of cash flows. This presents separately and rolled up both the bridge and the port. The information here is not as summarized as it was in the MD&A, so if you have any specific items that you're looking at, this is the place to take a look at it. You can see the interfund loan on page 11 at $10.5 million. It's a receivable on the part of the bridge. The likelihood is that they are not going to collect that, and it's a payable on the part of the port, and the likelihood is that they're never going to cut a check for it either.
I just want to talk about that for just a minute, just to
Certainly.
make sure that we have a proper understanding of this. Since the beginning of time, this is the amount of money that the bridge has subsidized the port.
Correct.
Thank you.
I gotta modify that just a little bit. And the reason I have to modify is because there is a note that discusses that at the end of the financial statements, which we aren't gonna get to right away, but we'll touch on it very, very briefly later on. And what it says is that while that is the amount of the debt that's been quantified between the two entities, not all the costs associated with the port have necessarily been reported to the port and allocated to the port. So the likelihood is that that number is understated, okay? How much it's been understated, I couldn't tell you. I couldn't tell you if it's $500,000 or another $10 million. All I can tell you is that because the port has been allocated certain expenses which are shared between the two entities, and as we discussed earlier, it's an estimated model that's used for the allocation. Could be high, could be low, but since it's basically the left pocket and the right pocket, it really does not make a significant difference other than the fact that you do report them separately.
Thank you.
Okay? Page 12 talks about what you owe, and there are a couple of items on here that are kind of important, maybe more or less. Obviously, the debt is all disclosed here in detail, particularly the long-term stuff. But the post-employment benefit obligations, which I do like to talk about at most of these presentations, it's roughly $250,000. It's right in the middle of the page, third item down under the non-current liabilities. That represents the estimate that has been recorded on the books of the health insurance commitment that the authority has made to its employees to provide them health insurance once they are retired. That's how much you've picked up so far as a liability. There was a provision that you could amortize that liability onto your books over a period of time, and at this point you've picked up $250,000. There is something just slightly in excess of $900,000 is the total estimate that's out there. okay?
Let me ask a question. When you say is it in this report where the amount of money the port is making, or is the bridge subsidizing the port, or is the port subsidizing the bridge? I mean, how's that, how do you come up with the numbers?
How do we come up with the numbers? I'm gonna ask you to flip to the next page, because the next page is our statement of changes. That's your income statement or your operating statement. This shows where the money came from and where the money went, okay, from a profit and loss standpoint. And when you flip to page 13, what you will see is that the bridge had roughly $3.9 million of income. $2.5 million in the form of tolls, and another $1.5 million in the form of rent. That income stream was directly attributable to the assets, because you are an asset-driven entity. That income stream is directly attributable to the assets that the bridge maintains and is responsible for. The port, on the flip side, has its own capital-related facilities that it manages, and it generated rental income on those, and it generated a significant amount of money of port operating fees. And the port operating fees, if you take a look over on that line to the far side, you'll see that in 2012 it was only a little over $500,000. Last year those port operating fees were almost $2.3 million. A tremendous amount of it related to those wind turbines, although that's dated 2008, but it was related to the wind turbine farm movement of those capital assets. Correspondingly, now this is kind of where it gets down to the question that has been bounced around here. Once you get down to the operating expenses, then it becomes the subjectivity pops in, okay? The revenue stream is pretty clear, because the revenue is derived from the assets that those entities manage. Once you're into the expense stream, your expense stream consists of basically two types of items, all right? One are charges that are directly chargeable to the activity based on the fact that this pencil is specifically used in the bridge fund, okay? That dirt was specifically used at the industrial park. That fuel was specifically used at the airport. But once you get down to your people costs and certain other costs, those are allocated. And then it comes down to is the model by which those costs are distributed between the two profit centers. And for purposes of this presentation on this specific page, there are only two entities that are involved. You have the bridge and you have the port. And within the port, it doesn't make a difference if it's at the airport, or the industrial park, or whatever. You've got the bridge and all of the port together. Now there's a schedule in the back that talks about the port by the different centers, okay? But at the end of the day, it's still part of either the bridge or the port. And as long as the distribution there makes some sense, then these numbers make some sense. And as the note discloses, and it is in the back of the statements, and I'm not going to have you flipping around because I hate it when people do that, but as the note does disclose, that allocation, because it is subjective, and because the port has not been able to fulfill its cash flow obligation and has had to lean on the bridge to support its cash flow, the model has probably historically not been such as to move all of the costs to the port. Because if you move all the costs to the port, the only thing that's gonna happen is the bridge is gonna have to move more money to the port to cover those costs. Okay, so, you could tweak that model, but it's not gonna necessarily change the outcome between, let's put it this way, it will have zero impact on the bridge and the Port Authority. It would only have an impact on the distribution of those costs in between. Your 2013 total column is gonna look exactly the same once you add the two entities together, regardless of where you buried that number. And when you take a look at the 2013 column in the aggregate, that's the total pot of assets that you are both receiving and what you are doing to spend those assets. And you can see right now, the biggest expense, you have three big expense items. You have your people costs, which is personal services and fringe benefits. And you have your depreciation, which is not a cash item. And the depreciation expense specifically follows the assets that each of these entities manage. And the port fund, quite frankly, those people costs, the lion's share of that was, the pickup between 2013 and 2012 was really the cost associated with the stevedores, associated with the wind farm, which is clearly a port fund activity anyhow. The rest is the administrative cost, which is subject to the allocation.
But them longshoreman costs was all built into a contract that we had.
Correct, and that's why the revenue
Right,
stream,
right.
which is also included here, is also attributable to the port fund,
Okay.
okay?
My question, backing up a little bit on, just for a minute, I wanna follow this, okay? Because I've been very interested in this in other organizations. It looks like you said, there's $10 million, and say that the port, we've subsidized them, or loaned them money, or grant monies, whatever. You say they may never come due either way. But if the port was to take off in the next 5 years and start making a tremendous amount of revenue, then I think that revenue, some of it should be paid back to the entity that made them viable to stay in there to pay back that debt. How does that work?
Well,
Because everybody thinks grant money is free. Just wanna make sure we get this clear.
Let's go down the path where you're taking us here for a second. Right now, there exists a $10 million obligation, and it is an obligation that is sustainable and supportable on the part of the Port Authority owed to the bridge. The Port Authority, the Port Fund starts to generate a lot of income. Either way, and it doesn't make a difference from whether it's the airport, the industrial park, doesn't matter, any one of its functions. That does not make the $10 million go away. What that does is that gives the port fund the ability to repay some of that $10 million back to the bridge. So that funnel of cash, which has historically been $10 million in the direction of going from the bridge to the port, can in fact come back the other way. There's nothing to say that it has to. That's entirely up to the board to say, gee, we've got all this money in the port fund now, maybe it's time to expand the port fund facilities. And instead of repaying the $10 million back to the bridge fund, there is a decision made that you're going to acquire more facilities to do whatever. That's a board decision to follow through on that. Or you could move it back to the bridge fund, and there's $10 million to go ahead and do part of your $60 million paint job.
Yeah, there you go, there you go, there you go.
Yeah,
That's what I wanted to hear.
but that's just cash flow.
I
Okay?
understand that.
Okay,
Thank you very much.
okay. Speaking of cash flow, that is the next statement that we're going to get to. That's on pages 15 and 16. And this, again, much like the border station, even though you manage a significant cash asset or significant capital asset, the operating statement outside of the depreciation is very much a cash type basis activity. You don't carry huge receivables, and the debt that you do carry is generally fixed asset or capital debt. And that is disclosed quite adequately, frankly, on page 15. And you can see the principal that was redeemed in 2013 was a total of $691,000, right smack in the middle of the page and column, in the 2013 column, and about $300,000 of interest. You put into service about $3.5 million of capital assets. That's where your cash flow went. While you generated $1.6 million of operating cash flow between these two entities, the bridge and the port, that showed up in cash flow provided by operating activities. That's what did you take in, less what did you pay out to your employees for operations. You took in 1.6, you paid 3.6 out in the form of capital expenses. And you did take in some, there's some grant money that's included in here, but not significant. actually, it's down there, it's $1.7 million. So about half of what you outlaid in capital assets was actually funded via grants. All right? Page 16 is a schedule that accountants put together just so they can feel good about themselves, I think. The notes here are quite extensive, okay, and I'm not gonna go through them in detailed fashion because we do not wanna have this 20-minute meeting or presentation be a 2-hour presentation, although it's a little longer than I'd care for right now. You have, your notes are from pages 17 to page 34, and they are copious, and they are detailed. They talk about your accounting standards and the items that are in your fixed assets and your cash assets. I'm gonna touch on 2 or 3 of them, that's all. And if you have any questions, I'd be glad to answer them, but for my purposes, I just wanna hit on a few. Pages 24 and 25 are important. They disclose the capital assets that are specifically identifiable to both the bridge and to the port, all right? And they show that you have got roughly $100 million, just in excess of that, of capital assets that you happen to manage. Page 26 talks about, a little bit about the donated, that's historical stuff, but it talks about your construction and process, okay? And there's $500,000 there, some at the airport, some at the marine terminal. The bottom of page 26, it strikes at the heart of the question that you had asked, and that's this interfund loan, that's the $10 million. And what it really says, and its last sentence says, the actual amount of this interfund account has been understated since not all overhead and indirect costs incurred by the bridge fund have been allocated to the port fund. That's over the course of years. That's not just 2013, that's since the date of formation, okay? Page 9 talks about the line of credit that you have in place and the long-term debt that you have. Most of your long-term debt is with the state of New York, with right now is a friendly lender. You also have a little bit of debt outstanding on the border station, which is about $3.9 million. That note goes on because the debt to New York State has got a wide variety of amendments to it. I'm not gonna go ahead and get into them here. They have lots of nuances to them. We're gonna get over to page 11. Page 30, which is note number 11. And it talks about your pension plan.
So wow, you jump back fast.
Yeah, I try not to go backwards and forwards.
Sound like me, Walter.
Yeah. I wanna keep us moving in the same direction for the document here. This talks about your pension plan. It's New York State retirement system. And what I'm gonna direct your attention to is actually on page 31, it's the first table. And just take a look at the change in the cash flow that has been required to fund your pension cost. 2 years ago it was $163,000, now it's over $250,000. It's a $100,000 pickup in the last 2 years. While that's a crushing increase, I'm unfortunate that you're not a very labor intensive, at least not through employees retirement system funded workforce. This is killing school districts, counties, cities, counties, towns, villages. If you're a big labor force employer in an ERS system, this number is causing all kinds of grief. Your post-employment benefits other than pensions, this is what we affectionately refer to as OPEB. And at the very bottom of page 31, it talks about your $930,000 total obligation. That is right now what the actuaries think your total exposure is for those health insurance benefits for your retirees in your current workforce once they retire. Because you were provided the opportunity to gradually write this onto your books, right in the middle of the table on page 32, it talks about the $252,000 that has been currently put up there. Roughly a little bit less than a third, about 25%, okay? It goes on at the bottom there to talk about your operating leases. This is really the border station, the lease. And note 14 is contingent liabilities. This is all kinds of litigation that's disclosed here, and the authority has got a little bit of it going on, not a huge amount, but it has a number of cases, and they are disclosed here. The larger ones are disclosed, and the rest are kind of just, this is not an all-inclusive, these are just the ones that are large and significant enough to be specifically identified. And I would assume that all of you are somewhat familiar with the litigation that is currently before the board. After that, we have a couple of schedules. The first one is just a presentation of the total columns of the operating statement, and therefore I'm not gonna go ahead and go through that. Actually, the one at the front actually has a little bit more detail, because it disposes both the bridge and the port. This is consolidated. Schedule 2 discusses the composition of just the port fund. And as you go through that, this is where your question is really structured. This starts getting into some of the allocation item, okay? How much time was spent in each of the individual areas? Is it appropriate? Is it overstated? It's really an estimate. At the end of the day, this is all what's been pushed over into the port fund, and whether it belongs to the airport or the railroad or the marine terminal, there are some records to support that distribution, albeit some of them subjective, but there are records to support that distribution. And at the end of the day, what this does disclose is that in 2013, on page 37, the 2013 column, you can see that the total of the port generated a loss of some $282,000. The marine terminal, which is really the product of the windmill stuff coming in, actually generated a very substantial profit last year, which offsets some of the losses of the other entities. But in the aggregate, you're still down $300,000. Okay. Page 38 is a required disclosure. It shows how much of your OPEB obligation you have funded. The answer is none. You are not unique there. You couldn't fund it if you wanted to, because there's no provision in state law for you to do that. And that brings me to the last two documents in here, which are ours. One is the report and performance of the GAGAS, which again shows no issues with regard to findings as far as your financial reporting is concerned. And the last 2 pages of the report are your compliance with the investment guidelines that are put forth by public authorities law. And again, it shows no issues there.
I would say this, I'm not sure what questions that we have for Dave or whatever, but I think as far as, I know it came, the format came in a different way this year because of the gas fee and how those changes came up, whatever. But I'd like to recommend for next year we do this the same way, because it seems to me that, we focused on this audit, and all those type of things, how this year analytically played itself out, whatever. So sometimes when we have these meetings, you come in for 20 minutes and we got other business items, whatever, and we're here for a long period of time, whatever. Not to say that we're not focused on this, whatever, and take it serious, whatever, but it seems to me that it's a main drive of what we did for the year, and say all those type of things and what we're doing and how things our staff are working, all those type of things. So I appreciate the way you've taken your time. And it's like, instead of taking 20 minutes, an hour and a half, 2.5 hours last night, whatever, we only see these numbers in the way that you present them in a different way to understand exactly what was happening. So I would recommend that we would do this same format again next year. And I don't know what it is for your cost and time, whatever, Dave, but it's much appreciated the way you did this. And anybody else have any comments or questions for Dave, go ahead. But I just think from my personal point was, I don't want to say it in the right way, but I enjoyed this session in a different way to understand a lot of different things and have the time to do the things and questions that are relevant to us so we can do a better job of what we do.
I would say the same thing, and I particularly enjoyed the fact that I came today and I kind of understood what I thought I understood last night, so that meeting was so important. I'm not ready to take the test yet, Dave, but I do understand many of the things, And although I don't wanna steal anything from you, Sam, I think for me to go to that meeting last night and see the skill set that Don Hooper brings to this board, in order to, you know, as you saw, the interactions between he and Dave, just amazing, and it helped us a lot, I think.
Absolutely.
His explanations and Dave's explanations, so I agree. I think the process should be similar and the same, and the meeting designated specifically for this. So.
Let me ask the question, how hard would it be to get your written notes, like you've got them in here, prior to the full board meeting? Because there's a lot in here that we haven't had a time to read or to look at and anything else, and then we're put in this room to, you know, I don't have a problem the way you're doing this thing. I might go back here and read this, and, you know, I don't like to have to call somebody to understand something. And to me, I like the way the format is here, but I like to be able to ask questions when you're sitting there, because I want everybody to hear it. You know, I like the mix, I like to have the discussion we had today was very good. I think you're one of the finest people that we've had do this. You know, for 28 minutes, it's well worth it. To me, as a board member, making policy here. Because I'm the guy that makes the policy. And I wanna make sure that your thing, I understand it. So, you know, I gotta read all through this, which I will. If I have any questions, I'll call you.
The timing on the, I don't wanna say the release of the documents, because they technically aren't released yet, this is still a draft. We typically try and get these out to the boards so that the board has in fact had a chance to digest them prior to it. We were still receiving information as late as, Fred probably knows better than I know, I wanna say as late as Friday, for sure, and maybe even a little bit later than that, to go ahead and actually tweak these numbers and get everything put together. And what the underlying issues were behind the timing, it's a different situation altogether, but the timing right now has actually been brought forward a month. You are subject to the public authorities law, and you have a 90-day after the end of your year filing requirement to get this put up on the Paris site. You have historically not made that, you will be able to make that this year. If I get my rep letter and this report is accepted by the board, this thing will come back to you with a date and signatures, and you can do your thing with it. And you will not be on the state's hate list for being late with your Paris filings. But typically, we do try and get these reports out to the board, and we try and coordinate that with the internal personnel that we deal with. Hopefully next year we can work on the timing a little bit better so that you get what you need to make this meeting, so that you can sit here and be in a more informed state as opposed to just being on the receiving end of the
Right.
dissertation.
I think one thing that would help too is if we separate the audit committee time-wise from the board meeting, so that way if we could add some time
Yes,
in between,
I don't
because
have
I
a problem with
know,
that at all.
that way would allow the document to get to, out there to the rest of the board members.
yeah.
But another thing that does too is that also provides a little bit of time for dialogue amongst yourselves, okay? It gives a chance for the board members to read through this and actually play 20 questions with the audit committee. And say, gee, what does this really mean? So it gives you a chance to actually be more informed in using this document.
Well, one of the things about it, being informed and reading it and trying to discuss it and stuff is because I know with the ethic rules out there and procedures, somebody say, well, how did you miss it? It was right in your report. It was on page such and such. That's all I'm saying. So you're right, we're headed in the right direction. Next year, maybe we'll be there. Thank you, Mr. Chairman. I don't have anything else. If you need a motion to accept this report, I'd be proud to make it.
Maybe
Go
make a
ahead.
comment?
Yes, sir.
In answer to Fred, we were behind the 8 ball, as was noted in this one audit comment here. You know, we were behind,
On the monthly,
but we were behind on everything, not just the bank reconciliations. We will be in place, and I thank you for helping and again, getting Karen on board. That'll make all the difference in the world. You know, we could have put any date we wanted to on those bank reconciliations when we did them. We made sure that we had the date on them that they were done, and they were signed on the date they were done, knowing that that was, that they should have been done when they, when they came in. We wanted to make certain that the information that the auditors had was not only accurate, but the timing on those were correct. Because when you do something with a computer and anything else, you can put any date on it you want to put on it. So I thank you for the help. We will get this right. We'll get this more timely, and we will get these done. But between being a little behind and moving it up a month, it was extremely challenging. And I'm thankful to Toski for their hard work in getting this for us today. Thank you.
I think one of the things that you have a real appreciation for is when you go through here is all the numbers and counting and where you configure and put these numbers in place in the right way. We're gonna have a real appreciation of the work that people have to do, to make these type of reports. And obviously, Dave, for your concise information and the way that you looked at this whole report is much appreciated, because it's, we wanna do it right, and that's what we always have to do. So, any other comments? I wanna thank Dave.
Well, the last comment that I do wanna make that, I would take out of last night's meeting is, if there's a question, he's available and wants to be called, because it makes his job easier for the next report.
Yeah.
So that was quite an important message.
Excellent. I think it's one of our best reports, or the way it's been presented for a long while. Do we make any formal action to accept this report yet?
Well, it's not in its final form, it needs to
No,
be in
that's
its
yeah.
final form, and at that
Yeah,
point,
and
yes,
then we'll
we have a
come back.
motion.
So we
to
just accept the report as presented at this point in time. Okay.
Is that right, though? I mean, I think, isn't that the purpose of the draft, that we accept this and then it becomes?
Usually, yes, because if we've already, let's put it this way, if we have issued the report, put our signature and it's dated, it's out there. And once it's out there, it's out there. Usually what happens is it's accepted in a draft form, and virtually any public authority that I have worked with accepts them in draft. And that is the date that you will see on the document. That'll be the date that we'll include in the client representation letter. And all we do at that point in time is turn it around. We pump out a PDF so that you can go ahead and start your filing process, and then follow that up with hard copies so that you can go ahead and actually give people paper if they like paper instead.
So we need to move this process.
At this point in time, that would be
Yes.
beneficial. The only thing that we lack at this moment in time is that I do have to get the management rep letter over to Fred, to be printed on your stationery and signed.
I made the motion to accept the report.
Yes,
I'll second.
As presented here today.
as presented here today. We have a second?
I second.
Second, any further comments? Doug, Anthony? No? Karen, any comments?
It's definitely different to be on this side of the process. I'm used to being on Dave's side, so it's given me a different perspective than,
Excellent. Well, I'm glad you got to attend the meeting. I mean, get you on
Yes.
board to start this process and, make everything work a little bit better, so
yeah.
that's, appreciate it all the way around. No other further comments, all in favor signify by saying aye.
Aye.
All right.
Yeah, I made the motion, I would hope.
Well, I mean, you might have changed it. You might have
I
baited,
did, Walter.
you might have baited me in to get it on the floor. Change your mind. Okay, thank you.
Thank you very much, Dave.
Appreciate it, thank you, Coach, appreciate it. Very nice job, thank you, very nice job.
Good job, thank you.
Pleasure to meet you. I hope I see you next year.
Thank you.
Have a safe trip.
Yes. You doing this?
Yes.
You know, both sides have their advantages, but I have to say in the future, I think that that's what you're doing.
That's the way I like it.
I never got to be in.
You're still on camera.
That's okay.
Everything,
That's the best,
is
that's
everything
the
okay?
best report that we've had in terms of.
Terry coffee in there?
Boss's
Fresh cup.
What I dealt with, where I
Play any golf, Doug?
was. What's coming?
Yep.
Okay, we're still in session. I want everybody to know we're still in session here. We're still on camera. Yeah, let's take a 5-minute recess and, make a motion to recess for 5 minutes. Steve, yes? Doug?
Yes.
Second, all in favor, aye. Let the record show it's 9:40. We just took a 5-minute recess and we're reconvening after our audit report. We have some unfinished business and Wade, you want to take us through that, please?
Sure. On page 2 of the special agenda, there's approval of a lease supplement with Era Shoes at the rate, terms, and conditions you see before you. Particularly of note, item 4 is a shoe company will provide proof of appropriate insurance to the authority.
Can you explain to me why there's zero increase here? What's the,
The zero increase in the first year is part of the negotiations to extend this to a multi-year contract.
what was it before? One year to year?
You know the history on that, Jeff?
I think last time it was 2 years. I think it might have been 4 with the 2-year out. They had an option to get out after 2 years, but they didn't. They stayed.
What is the reason for zero increase?
Keep him here.
It's a retention effort. The board was looking
That's
to
not true.
move the operation to West Virginia. He was under a lot of pressure to. There's an employee down there. The state's been trying to recruit them. It's less expensive transportation costs from there to the West Coast operations.
So their opinion really hasn't changed a lot because I see they got a lot of termination clauses in this agreement. So there really isn't anything, bonding beyond 60 days. If they want to tell you tomorrow they're leaving, this agreement leaves.
No, they're obligated for 3 years. The last time they were obligated for 2 years. So we have a solid contract through 3 years. And they didn't leave, during the last contract period.
I don't have any more questions.
Well, a comment I make for myself here, in percentages are percentages, and I don't know, we have consumer price index and what those expenses can be or not be, those things we can't predict. Seems that the price of oil's done a mess with that over years. But in regards to having at least a 3-year and a possible 5-year, at least I think that's tells us that they are committed to what they want to do and be here with us, and I think that's should be noted, John, that's a good thing. In my behalf, I think it's a good thing. And obviously for reporting and financial planning type of things, whatever, if you have empty space, that adds up to 0. When you got people in space, that adds up to the numbers that you're gonna come up with. So keeping that space occupied is over a long term, I think that's I thank them for doing business with us, and I thank you, John, for at least negotiating that type of length of contract. I'd like to see more of those for myself personally. Long-term investments in the area, knowing they're gonna stay here and work with us, and I think that should be noted also. Need a motion?
I'll move it.
Doug, second?
I'll second.
Second, any further comments, discussion?
I just
Yeah.
point out that it's an annual contract between $61,000 and $68,000 a year. If they stay for all 5 years, it's $323,000 to the authority. They have 7 employees, and they also paid an additional $45,000 in rent and utilities over the course of last year from extra space that they rented from
Yeah.
us.
Good contract. I know Mr. Carr, I'll finish the comment part of it, whatever, is a very well taken point, is why the 0, and it's a very good question, is that why do you offer somebody, raise whatever when our costs went up? And, But somewhere on the reward factor is the fact that you have somebody who's gonna stay at least 3 to 5 years, and that's what you got. I mean, I guess they call it negotiations, okay? No further comments, call the roll, or not roll, it's just all those in favor signify by saying aye.
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 Agenda item A2 on page 4 is approval of a lease supplement with FedEx Trade Networks. This is for a supplemental lease agreement for FedEx Trade Networks at the rates, terms, and conditions you see before you. This is for a 2-year agreement with a 2-year renewal option. Of particular note are other conditions of the lease that you see bulleted there. Steve, the second bullet, the following improvements will be made by the authority at its sole cost. Do you have a number on what that is?
All those items?
Yes.
Steve gave it to me and I have it here, it's $1,180.
Thank you.
How much?
$1,180.
I got a question here on the negotiations and these type of things. Whatever. I'm just saying I'm a client, and I'll just use some easy numbers here or whatever, and I come in and I say I need 1,000 square foot. He's over there. Over here is a person who needs 10,000 square foot. Is the price and the way you negotiate, I'm gonna get a better square foot deal for 10,000 square foot versus 1,000 square foot? Or is it just subject of what type of building is that it has, or what it, you know, the makeup of that particular building? I mean, but all things being equal,
Yeah, I would say it'd be a lesser,
he's gonna take more space, he's
Square
gonna have a better
footage,
square
yeah,
footage
yeah,
deal.
yeah.
Okay. I just wanted to know that
Yeah.
was, okay.
Just on this contract, it's 41 to 43,000 hours a year plus utilities over 4-year term. They do have an out after 2 years. 2 1-year renewal periods. If they stay for the 4 years, it's $170,000. The improvements are $1,180 or 0.014% of our income. There's 10 full-time employees that work there. I'm sure there's a ton of truck traffic, but they don't have a card, so we can't determine. But I would say the majority of the trucks that are in park are FedEx trucks at Strader Ferris or at FedEx. In terms of what we rejected, they wanted 2 years with no rate increase. They wanted $6,778 in broker's fees. We told them no. They wanted carpet tiles and paint throughout as selected by FedEx. We told them no. They wanted new carpet tiles in the front office and the warehouse customer service area. We told them no. And then they had some legal language that dealt with disclosing things publicly, which we told them no on. Going through the negotiations, FedEx was here with 10 top executives from throughout the Northeast and toured Building 11 and also toward Building 7, I guess it is, the privately owned one. They went through that building, so there was a concern that they could relocate their operations over to the other building. And overall, their general approach was that having annual increases, at some point you price yourself out of the market, and that the market doesn't support it, but we did get some increases, and happy to have them retained as a tenant and those jobs staying here.
Do you see any increase or decrease in our business with FedEx due to the new location that they're building in Watertown, which is triple the size that they are in Watertown now?
One is ground and one is, they're 2 different operations.
Mhm.
And they're trying to, so it shouldn't impact this operation here. And
Do we have both here?
No, just I'm not sure what it's called for.
Do we have ground here?
I don't think so.
No, just freight?
Yeah. And they have hired one employee to work in the Ottawa area to try and increase the business here, with the idea of growing and expanding, but that hasn't happened yet.
What can we do to help them with that process?
Well, we tried, we've made quite a few overtures to them, even with less expensive space in 2 or 3 different buildings. And that's when those 10 executives came up, and the buildings weren't ideal for what they wanted. and I don't think the business case was there, that's the issue.
Mhm.
We're definitely helping them with, not increasing their rent, that's definitely help.
Well, I'm not sure what the competitive rate in, auto is per
We'll never
square
know.
foot. Huh?
We'll never know that. They'll never tell you that
Well,
anyways.
I'm not sure about that. I mean, I don't know, but, I mean, that's what you are. You are in competition with other markets that have those type of buildings where we're gonna be, but we are who we are. I mean, if you wanna be here because of our location, bridge, and, you know, that's why they're here.
Now, when the negotiations take place for these, the whole management, I am assuming, because you kept saying "we," that means that the management team was apprised of these decisions and, were well aware of what the negotiations were and in agreement with it.
Yeah.
Yeah, go ahead, Frank.
You know, from a financial perspective, you know, I have a estimate of what our costs are going to do based on what our CSEA contract is and what we expect inflation to be, what it has been, what we expect it to be, and so on. And our costs are going up a little over 3% each year as we can see forward. So when I see zeros, you know, I wrinkle up my nose, but looking at them also, if the zero was in the column of amount per square foot because there was no one there, that's a significant, much more significant than not getting quite enough, to, you know, cover those cost increases. So, you know, based on that and the tough negotiations, I supported what that.
And I did as well, to speak to a process standpoint, prior to anything coming here to the board, it has to have 4 management signatures on it.
Thank you. Just so that you know, my position is, in my opinion, these are no different than a negotiations with a contract with CSEA or anything else. And when the management team can say to me, we feel very confident that we looked at this and this is the best contract we could provide, then you have my support.
I think it's been duly discussed and on the record, why the numbers are where they are and the rent of things, so let's make a motion, get it by.
Okay.
I'll make that motion.
Second.
Second? All in favor signify by saying aye.
Aye.
Aye. We also have, other such matters, any other discussions, reports, anything you wanna update us on, gentlemen? Go ahead.
Procedurally, for a special board meeting, there are no other such matters, so there's nothing to.
I make a motion to close the special board meeting.
Whole second.
I would just like to point out that I have updated the
I don't think we can do
bridge
that.
traffic. Well, it was before, I just wanted you to see it.
Yep, thank you.
Okay, so, we have a motion to adjourn, Mr. Carter, second. All in favor signify by saying aye.
Aye.
Shut her off, Ed.